Good afternoon, everyone. My name is Natalie with Sense Financial, a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Since 2010, we assisted over 3,000 clients to establish more than 4,000 self-directed retirement plans. And I see many of our clients are joining us today, and it's great to see you. If you are not part of the Sense Financial family yet, we would be happy to arrange a complimentary consultation with one of our retirement account experts to discuss how you can be in control of your retirement savings. Just be sure to contact us. I would like to welcome you all to another webinar with the topic of real estate tax strategies to supercharge your wealth building. I'm joined by two guest presenters today, Amanda Han and Matt MacFarland from Keystone CPA. Amanda and Matt are CPAs and tax strategists who specialize in helping people use real estate to save massive amounts in taxes and keep their hard-earned money. They help educate investors on how to maximize tax write-off, legal entity strategies, tax-efficient ways to access profit. They also help educate investors on how to use 401k money for real estate and much more. They are authors of the highly rated book, Tax Strategies for the Savvy Real Estate Investor, and they have been featured in prominent publications including Forbes, Finance Council, Money Magazine, Talks at Google, CNBC's Smart Money Talk Radio, as well as the Bigger Pockets podcast. Today, they have helped thousands of investors nationwide to save on taxes with proactive tax planning. Amanda and Matt will be covering a lot of information today, so if there are any questions that come up, please don't hesitate to ask. You can do so by typing them up in the Q&A chat, and we will make our best effort to answer them during our Q&A time at the end. But Amanda and Matt, thank you for joining us. I will let you both take over from here.
Well, thank you, Natalie. Appreciate it, and thanks for the nice introduction. Thanks for having us. It's good to be here, and look forward to talking to everybody and giving you guys some good nuggets today, hopefully.
Yeah, definitely put your questions in the Q&A box. We'll try to address as many of them as we have time for today. Yeah, I think Natalie covered most of the introduction for our bio. I think maybe the only things to add is that we are, our firm specializes in working with real estate investors, and because of that, we deal a lot in the self-directed investing arena because, of course, real estate investors want to use their retirement money for real estate rather than the stock market. So it's been a pleasure to work with Natalie and Dimitri over the years on kind of servicing clients and how to take control of their retirement funds and generate better results, because we all know that the stock market hasn't done super well recently.
Yeah, and so we are real estate investors ourselves as well. As Amanda mentioned, that's kind of what our firm specializes in, helping clients plan proactively to cut down on their taxes by using real estate and business and other things like that, which is self-directed retirement investing. So looking forward to diving into some good stuff and answering you guys' questions.
All right, let's get started with our first. We have a fun little quiz here for everybody to follow along the screen. The question is, which of the following celebrities went to prison for failing to file tax returns?
All right, so here's your options are Tim McGraw, Chris Tucker, Fat Joe, or Dimitri. Look at that. How do you get on there?
Yeah, you can put your questions in the poll in the chat box. Before we reveal the answer, the reason we wanted to put up this little quiz question was to let you know that tax strategies work differently for different people. So for all of us today on the webinar, we all have different personal, financial, and tax profiles. So what works for one investor may or may not work in your scenario. So what that means is, if you hear something that you like, the strategy that kind of sounds interesting to you, don't just go out and implement it. Make sure you seek out the advice of your personal or your real estate tax advisor, because what happens is then they can help take a look at your scenario and help ensure whether the strategies are good for you. The information we're providing today is educational only, and our goal is really not for you to become a CPA, but the goal is for you to have enough information so that you can start a very empowered conversation with your own team of tax advisors. Okay. So let's go for the answer. I can tell you it's not Dimitri.
Are you sure?
Yes.
As far as we know.
The correct answer is actually Fat Joe. For those of you who don't know him, he's a rapper who got in trouble with the IRS in terms of taxes and tax returns. So he went to prison a little bit briefly. The other people, Tim McGraw and Chris Tucker, were listed on here. They also got in trouble with the IRS, but they didn't go to prison. So Fat Joe was the only person who ended up going to prison.
All right. So we also want to kind of show you some numbers here, and and talking about how cutting down on taxes to help you build your wealth. Taxes really are the silent killer. Right now our highest federal income tax rate is 37%. So now that doesn't mean obviously if you're in the high tax bracket that you're paying every dollar 37% because we have graduated scales here in the U.S. But again, just painting the picture, highest rate is 37% for federal taxes. If you are fortunate enough to live in a high taxing state like we are in the state of California, you could be paying state taxes of up to 13%, believe it or not. And I know there's a few other high tax states out there too. Payroll taxes. So if you have your own business, you're working for yourself, you could be looking at paying payroll taxes upwards of 15%.
Or if you're just a W-2 person, you're paying payroll taxes as well.
Real estate investors, we know that when we sell rental properties, we're looking at paying capital gains tax on the sale. That could be upwards of 24% when you add in the net investment income tax. And then if you die without a good estate tax plan in place, they could, believe it or not, get to tax you again after you die. And you could be paying another 37% on assets that appreciate in value while you held them. So you can kind of see here that there's a lot of things that we're paying taxes on, obviously, and it can add up very quickly.
Yeah. So when you hear the comment that they've actually done research on this from taxfoundation.org time and time again that shows that the average American pays a lot in taxes. But let's go over a graphic, kind of a pie chart. So we did this just for fun, just kind of see, in a pie format, what does that look like? So this is for someone who makes $500,000 a year of income, and this is assuming a single person making $500,000 of W-2. After taxes, what you're left with is about $199,000. Okay, and this is after federal income tax, state taxes, payroll tax, and net investment tax. So you can see how little we are left with for someone making $500,000 in taxes.
No, I'm sure that's scary, right, or eye-opening for you guys. I mean, it's, as a CPA, that's still, every time we see this kind of pie chart, it's still eye-opening to us. Obviously, when you sit down and think about how quickly all these numbers can add up, right? Now, you guys have probably heard that expression, like, the more money you make, the more taxes you pay. I bet a lot of you probably have heard that. That's a common one out there. But I guess the question is really, is that true? Or is that always true? Is really now you can see here that we've got some pictures of some pretty famous people on here. You probably know most of them. You may know the last one, Brandon Turner, as well. He's a client of ours. There was a New York Times article that came out a couple of years ago that was talking about probably more in a negative light, right, of super uber wealthy people and how they can use all these crazy advanced tax strategies to save on taxes.
Yeah, I think they talked about Elon Musk, Warren Buffett, and Jeff Bezos, who made a ton of money but paid very little to no taxes using some of these advanced strategies that were only available for the super wealthy. So of course, as tax nerds, right, the two of us were like, hey, let's look into that. What are these advanced strategies that these people are using?
Super advanced.
And this is something that kind of like we can use or our clients can use. And so what we found was actually really interesting, that these advanced strategies were in fact not advanced at all. I think one of the things they talked about was that these wealthy individuals were able to tap into their equities and access cash without paying taxes. So if we talk about that from the real estate perspective, that's very similar to like a cash out refinance, right? So for example, I bought a property for $100,000. It's now appreciated to $500,000. I have a bunch of equity in there. I want to do a refi to pull out some cash and use the cash to live off of or invest in my real estate or my business. The cash out refi, you don't have to pay taxes on that right now. So not super advanced. It's something that a lot of you probably use all the time with respect to growing your wealth.
Yeah, I mean, you see people do it borrowing against. There's ways you can borrow against the stock portfolio as well, right? We see people do that all the time. Another thing they talked about in that article was after you've done this, accessing your cash without paying taxes by borrowing against it. They talk about, oh my God, how these people are allowed to write off the interest and deduct the interest on this additional debt. And I mean, that sounds crazy. Like as real estate investors, we're doing that, right? We're borrowing money, we're reinvesting the money to buy more rentals, and you're deducting that interest on those borrowed funds against the new rental properties. That's taxes 101 with respect to interest racing. So it's not believe it or not, not some super crazy advanced strategy.
I think the other one they talked about was like super wealthy people can sell assets without paying taxes. And I think for all of us as real estate investors, sounds pretty similar to 1031 exchange, right? Where you could sell a rental, have a lot of appreciation and not pay taxes on it. And of course, all of these also work kind of in the retirement world too, right? When we sell a property within our self-directed account, we're not paying taxes on that currently, and we don't even have to worry about a 1031 exchange. And then, probably you have heard about Peter Thiel back in the days, I think from PayPal, where he used his retirement money to invest in his business and was, basically able to get millions and millions of dollars without taxes. So self-directed kind of allows us to do something similar, right? I mean, we're not creating like these multi-billion-dollar companies, but on a smaller scale, we're kind of doing similar things when we use it to invest in assets like real estate, notes, syndications, assets where we have more control and knowledge into, right? So so this is interesting that you can kind of see, you can see based on the conversation so far why tax is one of our biggest expenses. We had a polling question earlier, how much do we lose to taxes every year? The result from the taxfoundation.org actually says that the average American pays more in taxes than they do in food, clothing, and shelter combined. So pretty scary stuff if you think about it, right? Because housing is pretty expensive now.
But yeah, it's still, as a CPA, it's still eye-opening every time we read or hear things like that. From a good tax planning perspective, I think that one of the things that we always look towards is what are some things we can do as ordinary taxpayers, business owners, real estate investors to cut in our taxes. And I think the first step in a good tax plan and the foundation of it is to look at understanding what and how, what deductions you can take and how do we make sure that we're not overlooking those deductions.
Yeah, and I think for investors, we're all really good at capturing our real estate related expenses like interest, property taxes, management fees, and things like that. But what we see missed most often are some of these personal expenses that really legitimately are part of business deductions. And so we've listed a couple of these here. Education, like if you pay for books or podcasts and things like that, right, to learn about real estate investing. Business meals, right? Whether it's you taking out other partners in your real estate deals or potential partners or your CPA for business meals. Those are also tax deductible. And for 2022, actually, for those of you who have not already filed your tax returns, business meals from restaurants were 100% deductible rather than the usual 50%. So that would be when you eat at a restaurant or if you order takeout or DoorDash from restaurants, those were 100% deductible for 2022. So make sure you talk to your tax preparer about that if you haven't already filed 2022 taxes.
Yeah, some other ones, common ones we see is travel, home office, car expenses. Home office is a big one that we see a lot of people overlook. Car as well. There's ways when you're deducting the business use of your vehicle to include depreciation on that. So if you guys are out buying, in the market to buy a new car, best bang for your buck when you're for depreciation for purposes is to find a car that's over 6,000 pounds. If you're going to use it 80, 90, 100% of the time for business, there's going to be a pretty large write-off waiting for you there if you can purchase that vehicle. So different ways that you can maximize your deductions. I think, again, on some of what we refer to as like the overhead costs of running your business that a lot of people tend to forget just because, it's not one of the day-to-day things of, my inventory or my salaries and wages or what have you,
Yeah, and I know we had a polling question earlier to kind of gauge what the audience tax rate was. I think most of you were at, middle to higher tax rates, which is interesting because I think most real estate investors probably don't pay too much in taxes. But nonetheless, everyone's scenario is going to be a little bit different. But it's really important to understand that for rental income, we do pay the same tax rate as we do on our other income, so ordinary rates. And so if you're an investor, if you have rental income, it's really important to make sure you track your expenses, because the higher tax bracket you're in, the larger the tax savings, right, against that income that you're generating. So some of these things might not seem like a lot on their own, but when you combine all of them together and when you track it across the whole year, they certainly could add up to get some pretty good tax savings. So let's go to our next polling question.
Our next question is, do you need an LLC to write off business expenses?
All right, so let me share the screen. So yeah, do you need an LLC to write off business expenses? Ooh, smart audience here. So yeah, the answer is no. We don't need to have an LLC to write off expenses. So from the tax perspective, what the government looks at is ordinary and necessary. So if you have an expense that's ordinary and necessary for your real estate or for your business, you can write them off regardless of whether you hold your title of your property in an LLC or if you paid for that expense with LLC money. So one example would be if you decided to go to a real estate conference, right? And but your rentals are held in your personal name, or you don't have an LLC yet, you're just starting out. Can that conference cost be deductible? And the answer is yes, because there's really no other reason why you're going to the conference except for real estate activities. Then that would be a business expense, regardless of whether you have an entity or not. Okay.
All right. So another strategy that we love to talk about our clients is what we refer to as income shifting. So you guys, I guess think about it like this: is probably ask the question sometimes is, how can I deduct money I give to my kids? And if you ask, 100 CPAs, 99 of them are probably going to tell you no. But I think the kind of better way to look at that is to how do you restructure, how do you rephrase how we're asking that question? So instead of asking, can I, ask the question of how can I? And the best way that we know to do that is through income shifting. So this is what we're talking about is just, can you find a way to hire your kids or, either even other family members in your business, have them work for you? The benefits are they're, teaching them good working habits, a good sense of responsibility. You get to spend more time with them. But you can also pay them, right? So just like any other employee, you can give them a pay. You're taking a tax deduction for it. Maybe, if you're paying your kids $10,000 during the year and you're at a 40% tax bracket, you're saving $4,000. Now, depending on how much money the kids make, it could be likely that those kids aren't actually paying any income tax on the money they receive. So as a family, you'd be saving as on a whole, right? So that's what we're talking about with income shifting. It's ways to, get a tax deduction for that money that I think we, for those of us who have kids, we all know kids are expensive, right? And we all know this is money you're already giving to kids anyway. So have them, give it to them, have them go pay for their own, phones and movies and TikTok videos or whatever they got to pay for these days. But
I know that Natalie and Dimitri probably are all over this too, but when you shift income to your kids or other family members, right? But for kids specifically too, once they have earned income, they can also open and contribute to a retirement account of their own. So, if you paid your kids, in Matt's example, $10,000, and your kids can open up like a Roth IRA or IRA and contribute. Let's say they did a Roth IRA for $6,000. They do that over a couple years. Now they're really starting to build some tax-free wealth, right, for the remainder of their lifetime. Especially like if your kids are younger, there's so many years of tax-free growth that's going to be available to them. So definitely a really powerful strategy. And I love what Matt said about having your kids, work with you and spend quality time with you. The kind of financial and life lessons that they can learn is really, really invaluable.
Wait a second. So I didn't mention this right, but we're married to each other. She just said spending time with kids at work would be quality time, but I always tell her that when we're working together, that is quality time. But she tells me that doesn't count as quality time for some reason. So
yes, that's not quality time.
Doesn't make sense. Contradict yourself.
It does make sense. All right, so we are sharing some crazy tax deductions allowed by tax courts. So the stories behind these are all different, right? Different tax profiles, different reasons why they were able to take some of these deductions. But what was really interesting is that these are a list of items that the taxpayers try to deduct, but the IRS said no. So the IRS disallowed these tax deductions, and the taxpayers fought the IRS and took these to tax court. And in tax court, they sided with the taxpayer, which ultimately allowed these deductions that you see listed here. Now, it doesn't mean that these types of things are all deductible for all of us here, but we wanted to share these cases with you so you understand that anything could potentially be a tax deductible item, but we must answer the question of whether this is ordinary and necessary with respect to our real estate, with respect to our businesses, right? And when you're meeting with your tax person, it's really important to ask more powerful questions, right? Like, not can I write off my girlfriend, but how can I write off my girlfriend? The girlfriend is actually, that case is actually one involving a real estate investor where this gentleman decided to write off the money he was giving to his girlfriend. IRS said no. He was able to ultimately prove in tax court that the money given to his girlfriend was for her helping him out in his real estate business. Therefore, it was a legitimate tax deduction. And so you can see this is very similar to what we just talked about, income shifting, right? But instead of shifting him to your kids, this person shifted income to their girlfriend, works in, in almost the exact same manner as well. Okay.
So let's go to our next polling question. Good segue to our next polling question. Does the tax court allow which of the following people to take a tax deduction for their breast implants? Yes, this is a real polling question, folks. Let's see what our popular choices are. Here is Dolly Parton, B, Chesty Love, C, Kim Kardashian, or D, Bruce Jenner.
Ooh, people are shy to vote on this one. Curious to see. Yep, we got some popular: Dolly Parton, Kim Kardashian. So while you guys finish up the voting, I will say one thing.
Kim Kardashian is a popular choice. She might have implants elsewhere, but
yeah, I think the reality is, I think if any of these 4 people on the list did claim implants for tax deductions, they probably could legitimately claim it, right? Even Bruce Jenner, maybe for medical reasons. Obviously, all the other people, including Bruce too, right? They're all people in the entertainment industry. So I think probably that, all of them could qualify. But the question was, which one of these went to tax court, right? Where the IRS disallowed it and the courts said they did. The correct answer is Chesty Love, which only got 3 votes, guys. And if I had to guess, those 3 votes are probably from guys. I don't know.
You can't be sexist like that. It's crazy. But yeah, so if you guys, Chesty Love was we'll call it an entertainer. And if you want to go, you don't believe me, go on your phone, do some Google searches, and then immediately delete your search history. But yeah, she took the IRS to court and was able to prove that she needed those to do her job effectively. It was ordinary and necessary in her line of business. So it may not be ordinary and necessary in your line of business, I guess, but apparently it was for her. So
yes, but one of the things that was interesting about that court case is, although they allowed a tax benefit for the breast implants, but they didn't allow Chesty to deduct it all immediately this year. If you guys want, you can put in the chat box as to what the ultimate decision was. So
yeah, they didn't let her deduct it right away. And the reason being is that these were fixed assets and they have a useful life of more than a year. So that's our silly tax humor. So
yeah, so similar to rental real estate, we'll have to depreciate the building. The same goes for breast implants.
Apparently.
Since we're talking about depreciation, obviously,
again, another natural segue.
For real estate investors, we always have to talk about depreciation because it's one of the biggest benefits of being a rental investor, right? Our ability to take depreciation on the purchase price of the building, regardless of whether the property is actually appreciating or going down in value.
Yeah, it's we refer to this as like a paper expense, right? So it's, you go out and buy real estate, you can pay all cash, you can get leverage, but obviously the goal of real estate is we're buying property that's going up in value. We're also trying to buy property that is cash flow positive. But hopefully, if it's cash flow positive with depreciation, we can take that paper right off on our tax return so that we're not paying any tax on the cash flow. Or maybe if the depreciation is more than the cash flow, maybe we're creating a loss on the property that may, is there a way that we can use that loss to offset other income? And there's different ways. There's regular ways to do. There's regular ways to do depreciation. The typical way with the residential property is 27.5 years. Can be 39 years for a commercial property. But there's also ways to supercharge that using like cost segregation studies where they kind of go in and find ways to take more depreciation sooner than later on the property.
Yeah, and depreciation, you can take it regardless of how much down payment is made. That's a common mistake we see, and because it's based on the purchase price of a property, really, the more leverage you're comfortable with, the better the potential tax savings. So let's look at an example. If you had $100,000 of cash you wanted to invest in real estate, right? Let's say we have two options. One, we can use that as an all cash deal and purchase a property for $100,000. So if we had to use a rough ballpark estimate, maybe we'll get like $20,000 of depreciation tax benefit in the first year. So pretty good, right? By a $100,000 property, I get a depreciation expense of $20,000 to offset my income. But what I can also do is use leverage on the real estate. So using leverage, then I can do $100,000 as a down payment and buy a $500,000 property, right? With that $500,000 property, maybe on average, I'm getting $25,000 of depreciation. So you can see how the same $100,000, I can either get $20,000 of depreciation for the first year, or I can get $125,000 of depreciation in the first year. And this is a great example of really how wealthy people use real estate, use the bank, and use the tax code to significantly save on taxes, right? Now, the one thing I do want to say, I think we had a question from Vanessa that said, when you take the depreciation, don't you have to get stung on the other end? The answer is yes and no. So what you're referring to is depreciation recapture, which simply means that if I buy property for $100,000 and I already wrote off $20,000, now my cost basis is $80,000, right? So eventually, when I sell in the future, a sales price of anything over $80,000, I'm going to pay taxes on it, right? So in other words, you're not able to double dip on taking a deduction twice. Something really important to understand is that depreciation is not a choice. So we have to take depreciation. If you don't take depreciation, eventually when you sell, you are still going to get stung because it is not a choice. It has to be done. Our choice, though, is we can choose whether we want to do accelerate depreciation or if we want to take regular depreciation. And that's part of the planning strategy, right? The answer to that will be differ for each of us on the call today. Let's go to our next polling question. Just wanted to know who is with us today. Are you guys investing in long-term rentals, short-term rentals, or both? And the reason we wanted to ask this question is because the tax treatment for long-term versus short-term rentals are somewhat different. And you might find some of that to be surprising as well. So let's see. Gosh. Mostly long-term rentals. We have some people doing both. Very few doing only short-term rentals. And the difference in long-term versus short-term rentals really is with respect to how and when we can use tax losses generated strategically from our real estate. And I say strategically is because these are our manufactured losses, right? Based on maximizing our write-offs and claiming depreciation and bonus depreciation. We're not talking about actually losing money in real estate.
Yeah, and so when it comes down to, and keep in mind from a tax perspective, the main difference between a long-term rental and a short-term rental and how you define them is a short-term rental is a property where the average customer use is 7 days or less for the year. If it's 7 days or less, you've got a short-term rental. If it's 8 or more, you have a long-term rental. Now, I know there's people out there investing in like midterm rentals or doing rental arbitrage, what have you, but really at the end of the day, from a tax perspective, 7 days or less, you got a short-term, 8 or more, you got a long-term. Now, in terms of using we were talking about losses earlier, right? We have cash flow positive with depreciation, income shifting, maximizing other deductions. If we can create a loss on that rental property, how can we use that loss to offset our other income? Now, with those of you who are investing in long-term rentals, which I think was majority of you, if you happen to be a high income earner, maybe making over $150,000 at AGI, then in order for you to use your rental loss to offset W-2 and other income, you or your spouse would need to qualify as a real estate professional. Again, the benefit of that is if you have losses on your long-term rentals, you can use those losses, deduct them in the current year against your W-2 income, saving taxes now. Hopefully, take that tax savings, reinvest, and continue to buy more properties, right? But in order to be a real estate professional, there's basically three requirements. You need to spend at least 750 hours a year in real estate activities. Second one, you need to spend more time in real estate than your other job or jobs that you might have. So that's one. That's a big hurdle for a lot of people, obviously, is if you're working full time. That would need you to estate to qualify, right? So that's why that can be hard. But again, maybe one person's working, one spouse is not, and focus on the real estate. That could be a way to negate that point. But so 750 hours a year in real estate, more time in real estate than your jobs. The third test for a real estate professional, equally important, is you need to meet one of the material participation tests or standards with respect to your long-term rentals. So what does that mean? That means that layman's terms, you're kind of actively involved in taking care of your own long-term rental properties. So your boots on the ground, you're doing a lot of stuff. One way to look at it, of that 750 hours I was talking about earlier, 500 of those hours are spent on your own long-term rental properties. So you've got your hands in there, getting your feet wet and all that good stuff.
Yeah. Now, alternatively, for people who maybe you're working full-time or you're running your business full-time and you don't plan on doing real estate full-time, but you still want to use tax losses to offset other income, then the short-term rental investment is probably a better scenario with respect to tax planning. And the reason for that is if you're investing in short-term rentals, you can use those losses against W-2 and other income, even though you're not a real estate professional. So you just have to meet one of the material participation hours requirements. There's several different ways to qualify, and we've done webinars on this one topic for over an hour. But the most common one to meet is 500 hours on your short-term rentals. Okay, so once you spend at least 500 hours on your short-term rentals, you can use the losses against all of your income without any limitations. So an example might be, if you're single and you work full-time, or you're married and you both work full-time, but you have a couple short-term rentals on the side where you might be self-managing it, or having 500 hours, then you can use that to offset taxes from your W-2 income. So it's a really a great way to use real estate to offset taxes, even though you're just doing it more on a part-time basis. All right, so let's talk about retirement accounts for a moment, because retirement. When we work with investors, retirement is one of your most precious buckets of funding, right, for all types of investments. Because if it's a traditional account, whether it's IRA or 401k, it's growing for you tax deferred. If it's a Roth account, Roth IRA or Roth 401k, then that's even better because that's money that's growing for you completely tax free. Right. And because most of our clients are real estate investors, a lot of times the decision that they don't want to make is, am I going to put money into my retirement account or am I going to use it for real estate? And this is where, the benefit of self-directed investing comes in, right? With Sense Financial can help you, because you are able to do self-directed investing where you contribute to retirement accounts, get an immediate tax deduction for it, turn around and use that money for real estate or real estate related investments like notes and syndications and things like that.
Yeah, the other to keep in mind too with respect to retirement accounts is there's a lot of options. If you have your own business, there's a lot of options on different types of retirement accounts you can do that are beyond the typical traditional IRA or Roth IRA. And the other thing too is there's a lot of flexibility in that you can, if you haven't filed your taxes yet, there's ways that you can still open an account now, fund it now, and take a tax deduction for the previous tax year. So those are different ways that you can still, continue to build wealth for retirement, putting money in setting aside for retirement, but also taking tax deductions at the same time.
Yeah, it's really interesting too. I think we had a couple questions about retirement account. Going back to paying the kids, what age can the kids contribute to the IRA or 401k? It's really any age, right? With respect to income shifting to kids and the retirement strategy, it's not based on age, but based on income. So they have to have earned income in order to contribute to retirement account. So do we, right? All of us, we have to have earned income to contribute to retirement account. But once we do, you can make the contribution. So that's what they're looking at there. Let me see. Oh, at what age can we hire our kids? So any age, you can hire your kids at any age into to help with your real estate business. The key though is that what they do for you must be reasonable and appropriate for their age and their abilities, right? So like a 3-year-old is not going to be your IT technician, but maybe like your teenage kids would be able to help with a lot of the, the IT or, online webinar type of things too. So
might be able to. I think.
Yeah, for sure we'll be able to.
100%.
So yeah, what can they do based on their age that's appropriate? What is the compensation for the tax that they're doing? That's more of what the IRS is going to be looking for. Okay. So now we wanted to go over real quick before we get to the Q&A part, tax savings in action. Earlier we talked about the New York Times article where they shared all these, tax strategies for these super wealthy people. The reality is, though, most of us here are not at that level yet in terms of wealth building, but we put together a client example so you can kind of see the power of tax planning and what can be done with someone with a lot less income than those people, right? Than the Jeff Bezos of the world. So here's an example. We have a married couple. One person is working full-time. The other person was a stay-at-home spouse who they decided to get into real estate investing. I think this is about 2 years ago. They bought 2 rental properties, and that first year they generated about $32,000 of net rental income. Okay, so this is after interest and taxes on property specific things. They did some income shifting. They had two young kids, but they were very young, so it wasn't like a whole lot, right? We weren't able to pay them like any crazy amounts, but the kids helped out a little bit. They got about a $2,000 tax deduction. They tracked their car and home office expenses. Again, nothing crazy. Didn't go out and buy a Tesla or anything like that, but just between like their regular car and their home office, they got about a $10,000 tax deduction. But here's the big one. They did a cost segregation on the 2 rentals that they purchased. I think the purchase price was maybe about $400,000 or so per property. And between the 2 properties, they got $198,000 of depreciation in that first year. Okay. In addition, I think they invested about $50,000 into a passive syndication deal with the cash that they had. And all in all together, they were able to reduce their income from $380,000 to just under $133,000.
Yeah, I mean, think about that, right? So just from $382,000 down to under $134,000, that's a savings of over almost $250,000 reduction in taxable income, and that saved them close to $100,000 in taxes. So we talk, going back to that example we gave earlier, right? That $100,000 can be a down payment on a $500,000 property if we're using leverage and continuing to build your wealth and all that good stuff. So for them, they definitely did the right things. They planned ahead, took advantage of the strategies that are available to them, and they saw the difference in their taxes for sure.
Yeah, and I think that's really kind of like probably the most common mistake we see when we meet with investors nationwide is that thinking tax return filing is the same as tax planning, and those are 2 very different things. Tax return filing, which most of you will be doing in the next couple of weeks if you haven't already, right, is meeting with your tax person and having them report what did or didn't happen on last year's taxes, right? Is reporting the reality of what it was. There's no strategies there. Tax planning, though, is working with your tax person throughout the year on doing the right things so you can make sure that you are maximizing your tax benefits. So a lot of things we talked about, right? Shifting income, making sure you're doing the right things, the right documents, the kids are actually doing the right things during the year, you're actually paying them the right way to get the benefit. We talked about, tracking your home and your car off, home expense and car expenses. We talked about real estate professional or the short-term rental loophole. Now, you can't just go to your tax person and say, hey, I'm a real estate professional. I think you want to be doing the right things between now and the end of the year to make sure you're tracking the hours, investing in the right type of properties to generate those specific tax savings. So in the coming weeks, as you prepare to meet with your tax person, make sure you take some time to talk to them about what you will be doing for 2023 so they can help you plan ahead strategically for the rest of this year. If they're too busy to do that now, then just make sure you circle back with them after April 15th to set up an appointment to meet with them. And of course, if your tax person doesn't provide planning services or doesn't understand real estate or self-directed investing, then it could make sense to seek out another firm who is well versed in that. So our next polling question really is, do you meet with your tax advisors to do tax planning? Just curious in the audience, how many of you guys actually do tax planning? You can let us know in the polling. And before we go to the Q&A, just wanted to share that if any of the information that we talked about today was new or newer to you, you can visit our website at KeystoneCPA.com to download our tax savings toolkit. Our toolkit is composed of strategies for long-term rental investors and short-term rental investors. We talk more about income shifting, real estate professional status, the short-term rental loophole, legal entity structuring, and all kinds of stuff. So make sure you check that out. If tax planning is something that's new to you, you can just use the QR code, scan it in on your phone, and you'll be able to access all that information for free. And of course, if you want daily tax tips too, outside of all these great tools, you can follow me on social media. I am Amanda Han CPA. Last name is Han, H-A-N, CPA. And with that, let's go to our questions and answers.
Yeah, thank you, Amanda and Matt, for all the information. We do have some questions that were submitted. Our first question is from Carrie. Please explain the AMT and how do we avoid the higher tax rate?
Explain AMT. That's a tough one. That's a very technical part of the tax code.
Yeah, I would just try and keep it as simple as possible. AMT stands for Alternative Minimum Tax. So it was created back in the I'm not this old, unfortunately, but it was created back in the 80s to make sure that what they call wealthy people back in the 80s were paying a minimum level of tax because they were using a bunch of loopholes to not pay any taxes. So they created this alternative way of calculating taxes. Over the years, it didn't get adjusted for inflation. So over the years, a lot more let's call them middle class people were having to pay AMT. So anyway, the tax code changed about 6 years ago, where AMT still exists. It's just not as much of an impact it's not impacting as many people anymore. The main things that you don't get to deduct for AMT are like state income taxes and some other things. But to be honest, it's what we're seeing in our practice is that it's not impacting nearly as many people as it did 5, 6, 7 years ago, just based on how the tax law changed. So AMT, I think the rate for AMT is 26-28%. So generally speaking, there's our graduated scales, people get up to 22-24%. Once you're up to there, you're probably already paying a higher tax than the AMT tax anyway.
Okay, next question is from Luke. Can you please clarify on 401k accounts? I thought UDFI hits when debt is involved.
That's a great question, Luke. So UDFI is so that it stands for unrelated debt finance income tax. Basically, it occurs when you use an IRA or Roth IRA to invest in leveraged assets. Right? Leverage meaning using my IRA as 30% down payment, getting bank financing to purchase the rest of the property. So that's where that kind of comes into play. But the benefit of 401ks and solo Ks is that that the UDFI tax does not apply. So sort of a loophole. I don't really know what the rhyme or reason is as to why it doesn't apply. But that's one of the strategies. So if you're investing in leveraged real estate with your retirement account, consider doing so through a self-directed 401k or self-directed solo K, so you can avoid UDFI taxes.
Okay, next question is from Pauline. I am an out-of-state real estate investor and have a personal portfolio as well as an LLC. Can I still use a newly purchased car as a write-off?
Yeah, Pauline, if you, for your, I'm reading this as saying like you have a kind of a more of a local portfolio in addition to out-of-state stuff. But if you have some local properties that you're using your vehicle to travel to, or various other real estate related activities that are local to you, those are definitely business miles. You should be tracking, what percentage of the time are you using that vehicle for business purposes. And you can still take tax deductions for that as well, for sure.
Okay, next question is from Carrie. I have a real estate license in another state where I own rental properties. Since I do not write offers due to buying properties in LLC, is the cost of the license a write-off under these circumstances?
Yeah, so you have a real estate license you paid for. If there's some direct connection to, having it with respect to your rental properties, I think it would be a business deduction. Otherwise, it would definitely be a business deduction against any real estate agent income you might be making, obviously, as well.
Next question is from Silandra. For calculating depreciation asset, do we take the total purchase price or asset value done by the township?
Great question. So depreciation, the starting point is based on the purchase price, the total purchase price. And then what you do is you allocate the purchase price between land versus the building. And the reason we do that is because the land you cannot depreciate. You can only depreciate the building and the improvements. So how do you allocate? How do you know what to allocate between land versus building? A couple of different ways. One is to look at the county tax assessor's information to allocate. Another one could be to look at appraisals. So if you recently had an appraisal done on the purchase, you can use that as well. The goal you're trying to get is to allocate as little to land as possible. Again, because we cannot depreciate land, right? So we want to allocate more to the building because that is eligible for depreciation.
Okay, we have a question from Mike. I am a high W-2 wage earner and have losses from syndication investments on K1. How do I offset my W-2 earnings with these losses?
Great question. Normally, rental losses are considered passive losses, right? Like Matt was talking about earlier. So unless if you or your spouse is a real estate professional, that's typically when you can use syndication losses to offset W-2 income. If neither you nor a spouse are a real estate professional, these syndication losses are considered passive, which just means that you are not using it immediately to offset taxes from W-2 income. You do get to utilize it in the future to offset taxes from other passive income, whether it's passive income from other real estate deals you hold, other syndication investments, this syndication investment, or maybe in the future when a property is sold, right, or the syndication is sold. In the year that the syndication is sold, it becomes an ordinary loss, and you can use it to offset all types of income at that point in time.
Okay, next question is from James. Is there any way to offset income from personal lending?
Offset income from personal lending. So I think there will be interest income.
Yeah, so if I understand the question correctly, so you're lending out money, you're loaning out money, and you're making, you're earning interest income on it. Yeah, interest income is one of those things that's like, it's taxed just like ordinary income, so it's taxed at the highest rate. Not a lot of deductions usually available when you're in that kind of line of business per se, especially if you're just not, just kind of doing it haphazardly and not as a everyday business. But if you happen to be, and we'll see this sometimes, if you're borrowing money and turning around and lending it out, so you're incurring a cost to get that capital, that cost is a deduction for you. So you've got interest income, but you'd also have investment interest expense. That's one way to offset it. The other suggestion I might make is this, to look at doing that lending inside a self-directed IRA instead of in your personal name, right? So, because that income, again, is taxed at the highest ordinary rate that whatever ordinary rate you're in. So that's great type of asset to be done inside a self-directed IRA, because it's just, you don't have to pay taxes right now, it's all tax deferred.
Okay, and next question is from Sharon. If you purchase and sell real estate within a self-directed solo 401k Roth, would that eliminate the need to do a 1031 exchange?
Okay, so if you purchase and sell real estate within a self-directed 401k or a Roth 401k, would that eliminate the need to do a 1031 exchange? Yeah, I mean, as Amanda was mentioning earlier, if you're using a solo 401k to invest in real estate, whether it's leveraged or not, there's, if it's not leveraged, there is no going to be any tax. You wouldn't need to do a 1031 exchange. If it's leveraged, cool thing about 401ks is they're not subject to that UDFI tax. So another reason why you wouldn't have to worry about doing a 1031 exchange inside your Roth 401k.
Another question from Carrie. I have real estate in a self-directed IRA. When the RMD is due, how do I keep selling the properties to pay the tax?
Yeah, that's a great question, Carrie. So you've got a self-directed IRA. If your required minimum distributions coming up and the assets in your IRA are these alternative assets, where do I come up with the cash to, take the distribution out? One way is to, if you have other assets in the IRA, obviously you can you can satisfy the RMD by if you have other cash in there, obviously, assuming that's not the case. One other thing you can look at is when you have RMDs due, you do have to, let's say you have 4 different IRAs, and you have to calculate an RMD from each IRA. And then you add up you add up the total amount of the RMDs you have to take. You're not required to take that amount of RMD from each IRA. You just have to take the total amount of RMD. So let's say, this self-directed IRA that's got real estate, the RMD is $10,000, and another IRA, the RMD is $20,000. Well, your total RMD in that example is $30,000. You can take the $30,000 from the second IRA without having to tap into the one that has the real estate. As long as you're satisfying the total dollar amount in terms of distributions, you're okay. But so that would be something else. But other than that, if you didn't have another IRA and you had to take an RMD, then yeah, if no other option, you may have to sell the asset in the IRA to generate the cash and have the cash inside the IRA, then to take the RMD. So hopefully that makes sense.
Okay, next question is from Mike. How do I generate a W-2 or 1099 when hiring a child?
So the 1090, so whether it should be a W-2 or 1099 really just depends on the facts. Typically, if the child is younger and or doing more recurring work, it would just be more of a W-2 situation. If they're older or it's more of a one-off project on a consulting basis, you might be okay with 1099. How do you generate that? W-2s, there are payroll processors who help with that. Or a lot of our clients use their local bank to do it. 1099 is usually just done, you can do it yourself online or via QuickBooks, or your bookkeeper can do it as well.
Okay. And then Michelle is asking, I have several rentals that I personally manage. Can I use that as self-employment activity to qualify for solo 401k?
Great question. So it kind of depends. If you are a property manager for other people, then yes, that typically is going to be earned income eligible for solo K. Now, if you are just managing your own rental properties, typically that is not self-employment income. It's just still part of rental income. We have had clients who strategically form a different entity, like an S corporation, and then where they will hire the S corporation to manage their properties, and then using that to open a solo 401k. So kind of just depends on the facts. It's definitely possible to do, but much easier when you're actually managing real estate for other people versus your own. If you're just doing it for yourself, you just have to take it maybe a couple steps further with different entities.
Okay, and next question is from Linda. I have a self-directed IRA that Dimitri set up in 2011. I had 2 rentals that I sold. I need a CPA that can get me accredited to invest in a company that does private loans. Will you be able to check me out to see if I qualify for this investment?
Yeah, great question. So many syndications will ask for accredited investor letter. So typically they'll ask for that from the CPA or from financial planners that the investor works with. We don't prepare those letters. But for most of our clients, there's a company called Verify Invest. So yeah, just verifyinvest.com, something like that. And it's really affordable. Basically, they'll generate the letters for you based on requests of some information. But before you go to verifyinvest.com, I would go back to the syndicator, or the sponsor, whoever's presenting the deal to you, and ask them if they will pay for the cost of that verification letter, because a lot of times they'll do that, right? It's a small price for them to pay to get your money for investment purposes.
AJ is asking, what is K1 syndication?
K1 is a form, so it's kind of like a W-2, right? And when you work at a job, it's called W-2. When you invest in a syndication, those are typically set up as LLCs. So what you get in terms when it's tax time is a Schedule K1. It basically shows your share of the tax income or tax loss from that particular investment.
Next question is from Matthew. If I buy a rental property under my name, but my wife manages it, is it essentially the real estate professional? Can I then take a loss?
Possibly. I mean, if your wife is a real estate professional, then yes, that loss can be used to offset your W-2 income. Now, having said that, just because she manages your rental, it does not mean she's automatically a real estate professional. So, what Matt said earlier, right? There's 3 major tests. More time in real estate than your job. So if your wife doesn't work, then she already met the first test. Second test she has to meet is at least 750 hours in real estate activities for the year. And the third test is at least 500 hours on the rental property. So assuming she meets all 3 of those tests, then she'll be a real estate professional for tax purposes, and then you can use the loss against your W-2.
Okay, and Olga is asking, in your example, if the syndication produces a K-1 with the limited partner checkbox, how does it reduce income?
In our example, Olga, the taxpayers they qualified as a real estate professional. They met as part of that, they met the 500-hour material participation requirement for their own long-term rentals. So under the tax code, in that situation, if they happen to invest in passive rental real estate companies that give them a K-1 with, losses because they're a limited partner, they are allowed to deduct those rental losses because they're a real estate professional and they met that 500-hour material participation requirement.
Okay, Remy's asking, do you have clients with real estate investments outside of the U.S., such as Canada?
We do have clients with real estate investments or rental real estate investments outside the U.S. I don't know off the top of my head if we have any that are particularly in Canada at the moment, but we do have clients that invest, kind of various different places, obviously.
Next question is from Wade. Who qualifies for disaster relief section 139, and what are the advantage deductions as percentage to one's AGI?
So so recently the IRS came out with some disaster relief announcements. We're here in the state of California where a majority of our state falls under one of those requirements because of recent storms and things of that nature.
Yeah, I mean, the disaster relief for state purposes basically says, I think it's most of California, there's parts of certain counties in Alabama and Georgia, I believe. So basically, instead of filing extensions beyond the March and April deadline and paying taxes by March and April, that eligible people can now not have to worry about filing extensions. So you're automatically extended until September and October. And also you don't have to make any payments that would normally have been due in March and April. So it's pretty beneficial for people who are in those impacted areas. The downside, I think, for us as CPAs is that is ever changing. So I think, on a weekly basis, we're getting, news update flash from our tax research providers on what they're changing with respect to dates and things like that.
And the other part of the question, average deductions is a percentage of one's AGI. That's kind of probably too hard to answer. I mean, it varies so much depending on where people live and what they have going on. Do they own their own house? And then the IRS doesn't necessarily disclose necessarily all that information either. Sometimes it's just based on some research and things of that nature. But
yeah. And obviously when you file your tax returns, your CPA is going to be calculating the details.
Yeah, and if something looks out of the ordinary, like, hey, your mortgage interest deduction is very large, for what we're used to seeing, that's one thing. But yeah, so hopefully it helps a little bit.
Well, that concludes today's webinar. Thank you, everyone, for joining us, and thank you to Amanda and Matt for all of the information. If you're watching this on YouTube, please give it a like so that it can reach more people. Subscribe to our channel. Share this video with others who can benefit from it, and feel free to contact our office if we can assist you in any way. And I hope you all have a wonderful day.